In today's video, I'm going to show you exactly how you can force a property to cash flow. I will be covering real estate investing basics and how you can engineer a money-making machine that will quite literally last you a lifetime. To first understand how we can force a property to cash flow, we first need to define what is cash flow. When it comes to real estate investing, cash flow describes a process of how much money is going in and out a property. And positive cash flow occurs when a property's monthly income exceeds the property's monthly costs. As a general rule of thumb for a one-unit property, most investors like to hit around that $100 to $200 a month mark per unit. Now, if we have a one-unit property that is cash flowing $100 a month, over the course of a year, that's going to be $1,200 in terms of profit. Now that we understand what is cash flow, we now need to understand and break down the components of what influences cash flow. Believe it or not, breaking down cash flow is actually quite simple, but the only issue is it is quite tedious. Cash flow equals the monthly income of a property minus the monthly cost of a property. And if you were to only focus on getting the highest cash flow possible for all of your properties, you will quite literally become a millionaire. And this strategy is so strong, people will sell courses for thousands of dollars just to learn what I tell you. Now, you might be thinking, this is way too simple. And you know what? I'm gonna have to agree with you because you're right. This strategy is simple, but do you know what is not simple? The actual application of this equation. A common rookie mistake for most investors is to simply glance over this equation. But the entire point of this equation is to establish a foundational principle that is referenced on a repeated basis. All we need to do is maximize this side of the equation. This means we need to maximize the income and minimize the cost. But now we need to take a step further and break down the components of the income and also break down the components of the cost. To start us off with the income of the home, I'm going to go ahead and disclose that there are a lot of things that influence the income of a home. And first we need to establish the different types of income. There's going to be short-term income and there's also going to be long-term income. Short-term income comes in the form of short-term rentals such as Airbnb, where people can expect to stay at the property anywhere between a day to a month. Long-term income comes in the form of long-term leases, where people can expect to stay at the property for at least a year. And for the simplicity of this video, I'm going to go ahead and only talk about long-term income through the form of year-long leases. Now, when it comes to taking a look at year-long leases, the ongoing rates for how much you can rent a house first depends on the property's location, size, amount of bedrooms, and the amount of bathrooms. Okay, and I'm only getting started. Then there's also a layered on component that influences the rental income in the form of the quality of the home. Is there AC? How's the neighborhood? How close am I to stores? And how's the overall quality of the home? At first glance, when you see a property that is for rent, you don't actively think of all the things that influence the rental rates of the house. However, when a renter goes into your house and is looking at a place to stay, they are passively thinking about their costs and benefits of a property. And not only that, they are comparing and contrasting your property with other competitors. Oh, I don't like the kitchen of this home. The closets in this house are too small for the massive bedroom, or the bathroom seems to be outdated. This is just a scratch of the surface level in terms of understanding what influences the income of a property. But I will go ahead and argue that this is the most complicated part of the equation. There are going to be diminishing returns on your investment, and sometimes it's not clear where you should spend your money to get the most out of the rental income of the property. This is where a lot of beginner investors make major mistakes. I've seen investors spend way too much money to improve one aspect of the house where their monthly income is practically not influenced at all. That is where having experience makes you a lot of money, because once you have one investment property that is completed, you can improve your procedure for the next investment property. And the main issue on this part of the cash flow equation is that you need to spend money to improve this side of the equation. Now, let's say you bought a property. Inherently, that property is going to have a specific amount in terms of how much you're going to rent the house out for. And the only real way to improve the rental income of the property is only by spending money. And at a certain point, what is the purpose of spending thousands of dollars to rent out a house for an extra $10 to $20? You could quite literally spend all the money in the world, but if your property is hard stuck in a bad location, you only have a limit in terms of how much you can rent the property out. That is why income is the hardest part to influence in the cash flow equation. But now it's time to talk about the part of the equation where you can actually force your property to cash flow even before you even buy the property. So far, we have covered what is cash flow, what are its components, and what are the components of the monthly income. But now it's actually time to talk about the components of the monthly cost. Here's when it actually becomes very simple. When you have a property, at the bare minimum, you're gonna have to pay for two things: property taxes and also insurance. Normally, your taxes and insurance are almost never gonna be higher than how much you could rent the house out for. The cost for taxes and insurance completely depend on the property, and as a general rule of thumb, monthly taxes and insurance can range anywhere between 20 to 50% of a property's rental income. Meaning, if you were to buy a house with cash, there's a high probability that you are positively going to cash flow on the property. However, when we are talking about a six-figure investment, quite frankly, not everyone can afford this type of investment. And this is when we need to complicate our strategy. Since we most likely don't have six figures, this is when we need to take out a loan to buy a house. Now, on the cost side of the equation, it is now not as simple as it is before. Before we could buy any property, we are immediately going to be cash flowing on a property. But once we include a loan on the house, things aren't as simple as before, because now we need to include the monthly cost of the loan. And depending on the loan structure, we can easily go into negative cash flow, which loses us money on a monthly basis. Now we need to become experts on structuring the loan. We need to understand the dynamics of how changing the loan amount, term length, interest rates, and how it all influences the monthly payments. Although this additional step of structuring a loan seems complicated, this is what actually allows us to force a property to cash flow. A great majority of the cost for a house can all be determined before we even buy the property, and we can easily get an estimate for insurance and also easily look up the taxes of a property online. Now, all we need to do is figure out the loan structure and how to force a property to cash flow for less than what it would cost to buy the house with cash. The only estimate that we are unsure about this entire process is, first of all, the rental income of the property, which is based on the property's condition of the home. One important thing to remember is that all of these things are estimates, and none of these estimates are set in stone. But do you know what? Having an estimate is infinitely times better than throwing a Hail Mary and hoping to hit your target. Now that we have covered cash flow and the components of cash flow, let's go ahead and do an example. Here we have a property that is worth $190,000, and using this spreadsheet, what we're basically going to do is just start plugging and chugging the numbers into our cash flow equation. As you can see here on this first step, we just need to put the property value, which is pretty easy to do. Now, next, the thing we need to take a look at are the property taxes. Usually for the property taxes, Zillow has them posted on their website. However, if you don't see them, then you can always just check your local county. So here, as we scroll down, here we can see that property taxes are going to be $3,895. So keep in mind that this is for the year of 2023. So what we need to do is, when we plug this into our Excel spreadsheet, we just need to make sure that we standardize it for a monthly tax rate. So we're going to put 895 divided by 12, and that gives us $324. Okay. The next thing that we need to go ahead and do is we need to estimate the homeowner's insurance for a third step. So what I'm going to go ahead and do is literally put home insurance for a 200K property. I'm telling you, it is literally that easy. So we're going to be looking, and the first thing that I can see is right here. And once again, this is just a random estimate. On average, homeowners can pay $1,876 annually for homeowners insurance on a $200,000 house. We're going to go ahead and plug that into the Excel spreadsheet. Once again, it is annualized, so we need to go ahead and divide that by 12. So here we have $156. Okay. One thing that you need to keep in mind when looking at this is, right now, if we were to buy this property with cash, all we need to do for this property to cash flow is to rent this house for more than it would cost to cover the taxes and also the insurance. Just here alone, we just need to rent the house out for $480, $190,000 property. Now that is very, very doable, but we're going to go ahead and take a little bit of a step further, and we're going to go ahead and get an estimate for the rental income. One thing we can do here is we can go ahead and take a look at a website called the Rental Meter. All we need to do is go ahead and put the property address and also put the amount of bedrooms that it has. So if we look back, there is 3 bedrooms, and we'll just do any baths. Check rents. Now you're going to be getting 4 numbers from this estimate. Now, just to keep this as a conservative estimate, we're going to go ahead and go to the 25th percentile, or also the lowest. And we're just going to also underball it again and do $1,400 for the rental income of the property. So here on our 4th step, which we already did, we put the rental income. So if we were to buy this house for cash, we would cash flow $1,000 every month we rent out the house. So if we were to rent out this house for $1,400, we are going to go ahead and cash flow around $920 a month. And let me give you some insights. As an investor, that is absolutely a ridiculous amount of money that you can cash flow. And this is just for the starting base. Imagine in the future, once you're able to increase the rental income of the property, whether or not it's through renovations or just naturally increasing the rents over the following years of the home. Now, things become a little bit more interesting when you don't want to pay all cash for the property and you want to go ahead and help yourself and finance the home so you can keep some money in your pocket. Now, when we take a look at step 5 for our Excel spreadsheet, we now need to include the loan. So we're going to go ahead and we found a lender that's ridiculous, and I don't know why they're giving me their money, but we're going to go ahead and assume that the lender gives me 100% financing on an investment property. Okay, so we're going to put $190,000 for this loan, and we are just going to go ahead and use a base rate of the 7% for our current market, and we're just also going to go ahead and use the standard years for a loan, which is 30 years. And we're also going to go ahead and say that this lender is even crazier and they're not going to charge us mortgage insurance. Okay, so we're just going to put 0 for mortgage insurance. So if we were to take out a loan for this house, our loan payment is going to be $1,264, and if we add that to our property taxes and insurance, our total expenses is going to be around $1,745 a month, which puts us in the negative cash flow. Okay, so now we need to consider, okay, how can we force this property to cash flow? Most of our expenses are coming from our mortgage payments, so all we need to do is just adjust our mortgage payment, and there's a lot of ways that we can go ahead and adjust our mortgage payments. Okay, like I said, we have 3 things that we can really pretty much influence. We have our loan amount, we have our interest rate, and we have the years of the loan. And what I'm going to go ahead and do is I'm going to go ahead and give you an example on how these things can adjust our mortgage payment. Out of these 3 variables that we can change, there's going to be 2 that really influence our mortgage payment. And the first thing is the base principal amount. So let's say that we want this property to cash flow with $200. Then what we need to do is we just need to pay out of pocket more for the down payment so that we can reduce the loan balance. So what we did previously, we just asked for a 0% down payment. Let's say we want to influence our variable so we can force this property to cash flow positively $200. So one of the first things we can do is we can change the loan amount or how much we borrow, meaning that we would need to bring a down payment. Previously, we came in with 0% down. So now what we can do is just reduce the loan amount that we borrow, and then we can go ahead and figure out how we can force this property to cash flow. What we want to check here is that this cash flow turns not red and shows $200. So we're just going to go ahead and start off with $100,000. With a $100,000 loan, we get a cash flow of $253. So what we're going to go ahead and do is increase that to $110,000. And okay, that gets us to our close target of $200 cash flowing. So if we would want to cash flow around $200 for this property, we would need to have a down payment of $80,000 if we were to only change the loan amounts. That's one example of being able to force your property to cash flow. You just borrow less. So now we're just going to go ahead and go back to what we had originally when we were in negative cash flow. So now what we're going to go ahead and do is we're just going to go ahead and change only the interest rate and see how that influences our cash flow of the property. So right now it's at 7%. What happens if we drop it down to 5%? The net cash flow decreases down to negative $100. Now we just go ahead and check this out. So what happens if it goes down to 3%? Now we're at positive cash flow of $118. So now what we do is, okay, what happens if it's at 2%? Great. Now we're at a cash flow positive of $216. Now keep in mind, this is with the original loan amount being $190,000 for the loan amount. So usually what a lot of people do is they just do a combination of the 2. Let's decrease the loan amount and also decrease the interest rate to hopefully see what we can do in terms of doing the interest rate. Usually what ends up happening is when you're talking to a lender, they have a lowest interest rate that you could hit, and those interest rates do cost money in terms of paying down for the discount points. So what you usually do is you kind of find the optimal balance between finding and paying for the lowest interest rate. So like right now we're at a 7. Let's say that we're able to find a really good lender and we can get a 6% interest rate, and then what we can go ahead and do is we just lower the loan balance down so that we can reach our $200 cash flow on our property. So 150 at a 6% doesn't work for us yet, so we're going to go ahead and do 130. So cash flow 139. Now we're just going to decrease that down to 110, see what happens. Okay, cool. At $110,000 we get a cash flow of $259. This is just an example on how you can force your property to cash flow and the different parameters that you can influence in terms of being able to structure your loan. Obviously, when it comes to the real world application of doing this, it's more sophisticated and there's more things that you need to account for. But as a beginner investor, like if you have this foundation foundational principle, and you can build off of this Excel spreadsheet or make your own Excel spreadsheet and fine tune your numbers, I will tell you one thing: you're going to be well off ahead of a whole bunch of your competitors. And when things get a little bit more spicy in regards to doing business in real estate, you'll be prepared to handle those more sophisticated problems. That's everything that I have for today's video. I hope you were able to learn a little bit more in regards to real estate investing and how you can force a property to cash flow. If you're interested in refinancing, buying a house, or selling your home, please feel free to reach out to me via phone or email, which is in the description and comments. And other than that, have a great day.